Well, good morning, everyone. This is Michael Douville coming to you from beautiful Phoenix, Arizona. Heather and I are producing another Creating Real Estate Wealth live webinar, and we're bringing to you a topic today that is near and dear to everyone's heart, and that's taxes. And we're going to talk about capital gains, how to defer them, and we're going to talk about when we develop fortunes, that we're talking about large sums of money. We're not talking about dribbles and drabs. We're talking about huge sums of money that we can keep working in our portfolio. And if we work everything right, after 40, 50, or 60 years of investing, we can set this up where all the capital gains are forgiven and your legacy is allowed to keep all of those funds. So first, next week, we're going to finish up my book recap. Now, we have been going over the fact that we've been doing how to create a real estate money machine and retire with income. I don't know if you know that, but we've been going chapter by chapter, bringing topic up, trying to inspire you and to motivate you to buy a lot of properties and get your life wonderful. We want you to bring us to your clients, improve their life, develop a retirement account, and we want you to retire whenever you want, because retirement is a financial decision. It's not an age. And we're here to help you to reduce your expenses, to build reserves, get more revenue, and to invest your money so your money will work for you. So next week, we're going to be talking about why this market works in any market, how the strategy will produce income and capital gains through all types of economies. And we're going to talk about my forecast. You're not going to want to miss that. It's a very positive forecast. And remember, I'm here in Phoenix. If you'd like to talk to me, if you want to brainstorm, you want to review your portfolio, just give us a call at corporate 602-942-4200. I'm more than happy to work this out with you. If you like these videos, it would certainly help me if you would like them and press that button on the YouTube when Heather puts that together. And you're always welcome to join. So let's move on to the very first slide. We're going to be talking about doing a 1031 IRC exchange. This is so valuable. As a real estate investor, you absolutely positively have to know that. If you're going to represent investors, you need to know what a 1031 IRC exchange is and how it works, what the difference is between an exchange and a traditional sale, what the difference might be between a traditional primary residential sale, the mechanics of how being able to do an IRC 1031 exchange. Very, very simple, but they are cut in stone. There is no flexibility on this. Easy to do, but they are follow the rules, step out of the lines, and then you have a taxable event. And it's a wonderful, wonderful, wonderful tool for 1031 exchange. Now, if you follow the strategy, and if you start this earlier, now on my strategy, we make an arbitrary guess that you should really have 10 properties in your portfolio, a minimum of 10. Now, this is just us. You can move 4 or 5, whatever you feel comfortable with, but no one tells you you have to stop at 10. Lots of investors are going to find out that this is an easy strategy to do. You're going to find out that it gives you enormous benefits. And if you time your investments properly, if you think this through, put in the growth of the economy, if you're in the great growth markets of America, like Florida, Texas, and Arizona, particularly here in Arizona, we're right next to California. We're getting so many people moving in. Over 100,000 net every year is putting pressure on housing, and it's driving prices up. So if you're buying and accumulating properties, you can have millions of dollars worth of capital gains, millions of dollars, particularly if you've been investing for 20, 30, 40 years. When you get to be my age, you can have a fairly sizable gain. I have lots and lots of my baby boomers have huge gains, and we're talking really large sums of money. Now, if you're working with a investor, it almost becomes a standard of practice that you know what you're doing. One of the questions, if you talk to an investor and you get a listing and they're talking about liquidating a property, I know a lot of things going through your head is, I get a listing. This is so wonderful. I'm going to be able to have something to work on. I'm going to have some sales. I'm going to have a client to represent. But what we need to really disclose and to talk with our client is, what is the client going to do with the money? That's one of the prime questions you ask. This would be a standard of practice. What are you going to do with the money? Now, we're coming up into a very, very strong part of the cycle. Lots and lots of appreciation is going to be made. A lot of investors had 10, 20, 30 years of gains. They're going to want to start liquidating, maybe capturing some of these gains. So you really need to ask them, what are your intentions to do with this? Because if they intend to buy more property, it's a completely different transaction than if they plan to just liquidate and take the money off the table. So we're going to talk about that, but you, as a representing an investor, this is something you absolutely positively must know, and you must bring this up with your client. You must say, what are you going to do with the money? What is your intention? So there's a huge, huge difference between doing a 1031 exchange and a traditional sale in the tax implications. The sale is the same. You know, it's so easy to do. So when we're talking about doing a 1031 exchange, we can defer the capital gains. Now, I'm going to tell you that oftentimes you might have $100, $200, $300, $400,000 of capital gains that has been built up in a property. And yes, it's paid at a much lower rate than ordinary income, but this is a capital gain that can still be deferred. So you, as a real estate professional or as an investor, need to know ultimately, what are we going to do with the money? If we're going to cash out, then we need to talk about the tax implications to make sure everybody is on the same page with that. We understand that. If your intention is to sell this property, buy another rental, then you must talk to your client about doing a 1031 exchange. So how does a 1031 exchange differ from a primary residence? Well, they're completely different. One's an investment property and one is not. So they're treated totally different. Your primary residence has wonderful, wonderful tax implications on this. As if you're a single owner on a property, you get to save the first $250,000 absolutely tax-free. That's the Capital Gains Tax Exclusion Act. It's yours. You can take it every 2 years. If you're a married couple, you can take up to $500,000 of absolutely tax-free capital gains for yourself. And you get to keep this money. No matter what you buy, that is the rule. It's not that you have to buy a greater than or more than it. You don't have to, if you sell your property for $1 million, you don't have to buy one for $1,001. This is a 2-year tax exclusion for owner occupants on their primary residential sale. So there's some strategies for that. You're more than welcome to come in and talk with us. We can often talk about building up capital gains, building up a capital stack. We're more than happy to work that out. We have strategies for that. If you want to do a consultation, this is a very, very prime experience. Now, I'm going to tell you, this does differ from our conversion strategy. So there's lots and lots of wealth strategies that we teach and that we know. So if you are a prime residence, and this is what you want to do, if you're married, $500,000 of gain comes to you absolutely, positively tax-free. If you're single, it's cut down to $250,000. There's a rule, you have to live there 2 of the last 5 years, but if you're there 2 years, that qualifies. You want to sell it, that's fine. You have 5 years. So if you convert it into a rental, you move out for 2 years, year 3, 4, you need to sell that property before you close on year 5, because you must have occupied that property 2 of the last 5 years. Easy peasy stuff, really cut and dry. We can easily do this for you. We can sit and consult with you. And you as a professional, as an investor, really need to know these rules, because saving taxes, can you imagine getting $500,000 absolutely, totally tax-free? Particularly in a market like today when we have huge appreciations. We're in that accumulation phase. We're going to be going into the explosive phase. Now, I know this is very difficult. I've been having conversations with other people around the world saying, how is it possible that we could be going into an explosive phase, because we've just come through this huge run up. I mean, the last year, 2020, saw the whole United States, the national appreciation rate was better than 11%. That means every hamlet, village, small town is thrown into the mix, and everyone went up 11% plus. When we're talking about some really big marketplaces like Maricopa County, you know, the entry level, which is our wheelhouse, went up better than 21% in 2020. So we're talking that you can get enormous capital gains. And what's even better than this is that delta between purchase price and rent keeps going up together, so that the rent goes up to justify the purchase price. Means we have a fairly healthy market. It's a fast market, it's appreciating, but unfortunately, I think it's going much higher. So just bite the bullet and let's get on the train and go buy something. You want to make sure you talk to your professionals, talk to your advisors, certainly talk to us. We're here to help you in any way possibly we can. So let's go to the next slide. So how does a 1031 exchange work? It is just so terribly easy. Now, if you have an investment property, and that is a huge universe, you can have all kinds of things. If it's an investment property held for investment, you can take a rental that you have cash flow and you've got a tenant in there, sell that on a 1031 exchange and buy a piece of dirt, as long as you plan on using that piece of dirt for investment. You can sell a piece of land and buy an office building. Anything held for investment qualifies for a 1031 exchange, and the profits for the capital gains from one property is transferred to the next property, and there is no taxable event. You're deferring the tax. This is completely legal. You show it on your taxes. We have a process for this. It's so terribly easy. Now, we often have properties. Now, remember, our depreciation is 27.5 years. Now, that means at 28 years, it's no longer getting a depreciable investment. So the best tactic would be to sell these properties, 23, 24, 25 years old. So we want to start thinking of getting the property sold. We have tenants that we're dealing with. Oftentimes this is their home. It's very difficult to uproot a tenant that's been there for 5, 10, 15 years. This is their home. So when we start to get into that mid-20s, we start thinking this property probably needs to be 1031 exchanged. So it's really easy. We just need to make that selection. The sale itself is the same. You put your property up on the market. We're now going to change that property's name to the relinquished property. That 1031 exchange is so terribly simple. You sell it. You just sell the property. It's the same thing. You market it. You put it in the MLS. You put a lockbox on. You get buyers coming through. You do the inspections. You can do it. Sell it FHA. You can have appraisers come through. It's just a normal sale until we get to close. So prior to close, you're going to hire a qualified intermediary, a QI, a 1031 exchange company. They're going to send you some docs. We're going to get that done prior to close of escrow, and we're going to disclose the fact that this property is going to be used for IRC 1031 exchange. There's some documents. There's a little bit of some verbiage that should be used on it, but the main thing is that we want to hire a qualified intermediary. When we close the property, we send that money to the qualified intermediary. We don't get the money. Now, there's ways if you want to take money to it, that's called boot. We'll get into that. If you want to talk a little more about that, we certainly can. But for the most part, you take that 1031 proceeds, send it to the seller or send it to the qualified intermediary. You do not take proceeds of that. Now, we have 45 days. So closing is day 0. We have 45 days with which to identify a property. And I'm going to tell you, in a market like today, you better do more than just identify. You better start closing on these properties. But the law says 45 days with which to identify. So you might find 3 or 4 properties that you'd like to buy. You send those addresses and legal descriptions to your qualified intermediary saying, I'm going to buy one of these properties or 2 of these properties. There's lots of different ways you can do this. The typical 1031 exchanges, you sell 1, you buy 2. That seems to be just the normal way. Now you have to go ahead and buy equal to or greater than what you relinquished, and you have to use the same amount of mortgage equal to or greater encumbrances on the properties, and that's an easy rule. You can add more. You can replace the mortgages with your own personal cash, but you need to put more on it, equal to or greater than the relinquished property. So you have 45 days with which to do this. We have plenty of time to do this. There's generally just not a problem, even in a market like today where it's really fast and furious. We certainly can do this. Now the purchase price, again, must be equal to or greater than the relinquished. Oftentimes we buy 2, 1 buying 2. So the new residential property, you must absolutely positively must close the replacement property within 180 days. Now, this can allow you to buy new. You'd have to have worked that out and done strategy. That's why it's so important that you're working with your investor or your investor is working with a professional like us so we can make the plan, so we know what we're going to replace the relinquished property with. We have a strategy, a plan. Always, we want to know what are we going to do with this money. So we don't want to just sell it. We want to have a plan as to how this is going to do. Now, when you go to close your new replacement property, so easy. It's just the normal closing. You get to do the same things as you normally would. You buy the property, you negotiate the property, put it into escrow. You tell the qualified intermediary we're doing this as one of the properties we're replacing or properties we're replacing. We get it inspected. You can get it appraised, you can put cash, you can put more mortgage on, just make sure that it's equal to or greater than the mortgage that you put before, and you close the property. Now, the qualified intermediary will be notified to send your cash, your funds, to the closing. You never take personal control of the money, and this qualifies for a 1031 exchange, and it becomes tax deferred. You've gone ahead and restarted your depreciation clock and deferred the sale. You deferred the capital gains. It's easy peasy. So let me just go through this with you. I want to talk to you about doing a stepped up basis as well. But I want you to understand we're talking lots and lots and lots of money. People say, oh, it's only a few $1,000s. But you know, this few $1,000s, it's not a few $1,000s. This is an actual example from one of my investors. We bought this property in 1994 for $62,500 and just recently sold it for $261,000. A very, very nice gain, almost $200,000 in gain, even though it's long-term capital gains. We have a 20% tax liability, almost $40,000 in taxes, but that's not the only tax. You have recapture on the portion that you depreciated, which in this instance, it's $48,000. So 25% recapture. So another $12,000. You also have Medicare surcharge, the Obama surcharge, 3.8%, $7,500. And we live in Arizona. We're a reduced tax state. It's not like in California where we have 13, almost 14% of state tax. We still have 4.5% here in Arizona. It's almost it's $8,700. So you put all 4 of those taxes, and $198,000 gets whittled down by $68,000, it's going to go to Uncle Sam. $68,000. Now, I'm going to tell you, this is just one property. You know, we're advising you to buy at least 10. So this happens on all your properties. That would be $680,000 in taxes that you're paying that you don't have to pay. Do you think $680,000 that you're not paying taxes on, but you can defer and earn on is important to you? Of course it is. It's incredibly important to you. Now, we have a saying that stepped up basis mitigates some of the sorrow of death. And that's because here in Arizona, we're a community property state. So if you aren't in Arizona and you're holding your property in joint tenants with right of survivorship, you're only getting half of the stepped up basis. So the dying spouse gives the properties to the surviving spouse at stepped up basis. So if you had $100,000 in purchase, then the $50,000 is going to be stepped up to the new owner, and they get that at a stepped up basis. Here in Arizona, this property, if you look at this where one of the spouses passes away, they bought it for $62,500, and if both spouses passed away, the new basis, the new stepped up basis, because in community property states you get double stepped up basis, both surviving, because it's held as a community property with right of survivorship, and a married couple, their new basis would be $261,000, and all the depreciation would have been forgiven. So that $68,000 that you've been deferring upon the death of one of the spouses goes to the surviving spouse. You don't pay taxes. That money doesn't go to the government. It stays within your family. It goes to the surviving spouse. So it becomes very, very, very crucial that you do these 1031 exchanges. Not only do you step up and start getting your depreciation back, but you're saving tens of thousands, if not millions of dollars for the surviving spouse, and then family inheritance. And this goes back to you as being a professional and being an investor, knowing what your tax liabilities are. Now, if you have any kind of questions, you're welcome to call us. I mean, I'm here at the corporate office. You're always welcome to get a hold of me. Come in and see me. We can set an appointment for you to come in and see me. And we can go over these for you. Easy peasy. We have lots and lots of room for you. Now, next week is the recap. We're going to be finishing up. We're going to talk about why this works in any market, why this strategy is good, why we're going to go through a couple different cycles, and how, just as an investor, you certainly expect to go through a couple cycles. And it's knowing where we are in that cycle. It makes a huge difference to you. And we're going to go into my forecast. You're going to like the forecast. The forecast is going to be great. You're going to be really, really pleased with that, because fortunes are going to be made. Now, if you like the video and it's up on YouTube, please push the like button. You're welcome to subscribe with us. And if you would like to get this flyer, you are welcome just to email at creatingwealth@westusa.com. If you have any questions or comments, you're welcome to reach us at creatingwealth@westusa.com. Now, I'm going to tell you one other thing. June 17th, I'm teaching real estate investing for beginners at the corporate office. June 17th, it's going to be a pretty long seminar, probably 9 to 3. Going to take you by the hand. It is for beginners, how to get started, how you can go from absolutely nothing to having millions of dollars. It is a process. It doesn't happen overnight. But I'm going to tell you, the moment you start the strategy, your life starts getting better. You start getting benefits. So we're going to teach you how to do that. We're going to talk the conversion strategy there. That's June 17th. I'm speaking around town next month. It's the first time I've been speaking, so I'm going to be around. Look at the calendar. I'm more than happy to talk to you again. But if you look at the calendar, you'll see our dates. So any questions or comments or thoughts, email us, creatingwealth@westusa.com. I'm going to tell you, it's great. It's a very good market. If you have questions, call me. If not, go have a great day. My very, very best to you. Bye-bye now.